Hello and welcome to this week's BizSmart Lunch and Learn webinar. Our weekly webinars are aimed to provide advice and share knowledge amongst business owners on key business topics with specialist areas. This is part of our service to our Smart Room members. If you are not already a member or a BizSmart client and would like to access our archive of webinars, then please visit our website biz-smart.co.uk and go to the Smart Room page. Our host joining me today is BizSmart Select Member and Advisor Ian Priest. But before we start the webinar, can I ask you all to use the question mark function on your screen to post any questions that you may have for Ian, and he will do his best to answer them all at the end of the session. Thank you, Ian. Over to you.
Thank you. Today we're going to be looking at financing growth. There are many ways to finance a business, and they fall broadly into two categories: internal and external. Most businesses jump straight to external funding and rarely look inside the business. The reality is you should do it the other way around. Always look inside first to see if you can generate the cash from within the business. The most obvious source of internal funding is retained profits. That is, you don't take all the money out unless you have to. But there are other internal sources of cash, and they sit squarely in your balance sheet. Fixed assets. Has the business got any assets it no longer needs? To give you an example, one of my clients was struggling to raise the money to pay HMRC. I asked them if they really need all the, what appeared to me to be scrap metal in their yard. They didn't. It produced tens of thousands of pounds. Stock. Are you holding more than you need? Can you cut your stock holding? Can you sell off old or surplus stock to generate cash? What about your debtors? Are they paying on time? Are you giving too much credit? Take a look at your internal systems and see if by implementing a better process for collecting your debtors, you can collect it quicker and get the cash into your bank account. What about your suppliers? Conversely, are you paying suppliers quicker than you need to? Again, to give you an example, I had a client who asked me to help him raise £600,000 to pay for his divorce settlement. After doing some basic analysis on the first afternoon, I told him I'd got the first £500,000 already sorted and it would cost him exactly nothing. I'd spotted that in his accounts department were paying the invoices the day they landed on their desk, rather than take the trade credit terms. I suggested he wrote to all his suppliers saying a new finance director had been appointed, and to streamline procedures in future, all invoices would be paid at 45 days after the month end. Not a single supplier complained, and in 10 weeks he got more than £500,000 sat in his bank account. So, before you rush off to the bank, look inside the business, but also stop and check out if there's any grant funding on offer. Help finance your project. If you can apply for a grant, then do. It's free money. But beware, they can be complex to qualify and they can be time consuming, and you have to understand the rules. Generally, you have to pay for the item and claim the grant back, and normally you can't even order the item till the grant's been approved, so make sure you don't fall foul of the labyrinthine rules. But free money is free money. Debt or equity, and the pictures are a dragon, as in Dragon's Den, who suggest they provide equity, and a black horse. I think we all know what the black horse stands for. Debt can be expensive, but have no misillusions, equity is even more expensive. Dragons don't invest for fun. They don't want 25% of the business. They want 25% of the profits of the business and 25% of the value of the business when it's sold. They'll also want a seat on the board and will want to tell you how to run the business and how and when you sell up. It can be the making of a business, because having an external investor can open doors from their own contacts, but beware you don't get eaten. Debt, on the other hand, is paid for as you use it, and you pay the lender an agreed return on their cash, and they normally have very little say in how the business is run. However, you need to watch out for covenants, which are promises to do or not to do something. So for example, your bank may put a covenant on that you can't take any of the borrowing without the bank's consent, or you can't dispose of any assets without the bank's consent. If you did, you'd be in breach of covenant and the bank can call the debt in. Other types of covenants might be that the debtors that are owed to the business will always be a multiple of the amount you're borrowing. And again, you have to be able to provide that information as and when the bank require it. So what type of debt is there? The most obvious are loans and overdrafts, but don't forget credit cards. Directors' loans, can you put money into the business? A commercial mortgage on a property, invoice finance, HP, or even import or export loans. For a small business, the old-fashioned overdraft was a godsend. However, banks don't like overdrafts because they have to put aside capital for the borrowing, but you might never use it. Loans are more popular with lenders because they know you'll take the money, but the flip side is very often you've got a loan account with borrowing on it and cash sat in your current account, which means effectively you're paying to borrow your own money. Credit cards. If there's an interest-free period, great, but don't get sucked in more and more, which is always the temptation with cards. It's plastic, it's not real money. You have to be very disciplined. Directors' loans, as I said before, can you lend money to the business, or can a family member put some cash in to help you? Then we get onto invoice finance, which bankers will always tell you is a really simple product. It isn't. It's a very, very complex product. Invoice finance ranges from single invoice factoring to a full confidential invoice finance facility. Effectively, you sell your debtors so that you get paid quicker. It sounds simple, but as I said, it's very complicated, and it's certainly not right for every business, despite what their bank manager may say. If you are considering taking invoice finance in any form, please take some independent advice. HP is a great way to spread the cost of plant and machinery. You're paying monthly as you use it, and the capital element is usually covered by your depreciation, and the interest is a business expense. Import and export loans, as the name suggests, are short-term facilities to help you fund imports or exports. Lenders, there are specialist lenders that will do this type of funding. They want to know that you've got a buyer for the goods, and that buyer is going to be in a position to complete the transaction. But if you are bringing goods into the country to on-sell and you've got a signed contract for them, generally you can fund that quite easily. But the bank said no. Well, banks have a habit of saying no. Not if you believe their statistics that they sanction 8 or 9 out of 10 applications, you'd think they never said no, but the vast majority of requests never get to application stage. So banks often say no to businesses they should be helping. Often it's because the request is not presented in the right way or with the right information to back it up. You have to bear in mind that there are 3 types of bankers. There are some great ones, there's some not very great ones, and there's a lot of lazy ones. However, they've all got one thing in common. None of them got enough time to do the job properly. So if something's messy, if they don't understand it, if it's a sector they don't know or understand, they don't have the time to dig into it, so they say no, because they've got a little voice on their shoulder saying too much work, too much work, too much work. Somebody once told me the best way to get cash out of a banker is to turn him upside down and shake him. The second best way is to get someone to help you present your case properly in a way that banks will find easy to digest and understand. Even with well-presented cases, banks can and still do say no. But they're not the only lenders out there. There are peer-to-peer lenders, such as Funding Circle or ThinkCats, for example. And there are community lenders like BCRS, ART and Impetus, who can only lend to businesses that banks have already turned down. So, how do you go about presenting your case to the bank? You have to prepare your submission carefully. If you don't know how to go about it, get some help. And then following that, make sure you get the right product. Take advice, but not from the banker. Bankers undertake a risk assessment of you and your business. They want to know how they're going to get their money back. The key question when I was a credit sanctioner was, is it safe? The easiest way to get them to say yes is present them with a fully reasoned risk assessment. If you can't do that yourself, get someone to do it for you. Get the product that's right for you. That's not necessarily the one the banker tries to sell you. They are often looking at what's best for them and their targets, not what is best for you. Shop around. Just because you banked with them for 30 years is no guarantee you've the best deal. Bankers don't tend to offer the best deal. They do offer the best deal they think they'll get away with. I had a client a few months ago who'd banked with his bank for 35 years, and he told me that I wouldn't be able to get him a better deal than he'd already got from his bank. His bank had offered him 3.6 over base with a 1% arrangement fee. I managed to get him the same lending at 2.45 over base with no arrangement fee. I think I saved him about £70,000. So that's a quick whiz through funding growth in your business. Don't miss the opportunity to try and get cash from out of the business by tightening up on your debtors, getting rid of stock and assets you don't need, or taking trade credit terms where you can. That generates a lot of cash and it costs you absolutely nothing. Quite happy now to take any questions.
Okay, thank you, Ian. You've had a couple of questions come through. If anyone would like to post any questions for Ian, he can answer them now. The first one is from Sally, and she's asked, what are peer-to-peer lenders and why are they different?
Okay, peer-to-peer lenders are a relatively new phenomenon. Phenomenon. Oh, I'll get these teeth in right one day. They've only really come into existence over the last 5 or 6 years since the credit crunch. And effectively, it's people with cash, business owners and private individuals, who are looking for a better return than they will get from a bank, and they lend their money to businesses for interest. So you put your request into a peer-to-peer lender, say you want to raise £20,000. The peer-to-peer lender does a credit risk assessment, very much the same as the banks do. And if they are happy that you are a good risk, they will put the opportunity on their website. The investors then see the details of the loan that you want to have, and they bid for a piece of it. So if you're an investor looking at that loan request for £10,000, you might say, that looks a decent business, I'll have £500 worth of that, but I want 8% interest. Somebody else might look at it and say, I'll have £1,000 worth of that, but I want 9% interest. And so it goes on until the full 10,000 is raised. After that, if somebody else wants a piece of that loan, they've got to bid a lower interest rate than somebody who's already in. So once the loan's filled, then the interest rate starts to come down. But generally, they raise the money within 3 or 4 days. The application process is very simple. So why are they different? They will look at cases that the banks have turned down. They do have a different set of criteria. There is a slightly larger risk appetite, but with a higher interest rate. They are very quick. They turn it around very quickly because you're borrowing from a group of individuals rather than from a bank.
Okay, thank you very much. Your next question is from Stuart, and he asks, why do banks love invoice finance?
What's not to love about invoice finance? I mentioned earlier that banks don't like overdrafts because when they lend money, they have to put capital aside to cover the risk on that loan. It used to be 8%. There's all sorts of weird and wonderful calculations now to work out how much capital they have to put aside. But let's assume for argument's sake it's 8% still. So if you've got an overdraft facility of £100,000, the bank has to put aside £8,000 worth of capital to cover that loan. If you're not using that overdraft, that's wasted capital. But the question was about invoice finance, not overdrafts. Invoice finance isn't classed as borrowing. The bank is buying the invoices off you. So they don't have to put that £8,000 capital aside. So for the bank, it's a lot cheaper to provide the facility. They get more security because they've got a direct charge over the book debts. In fact, they've probably then got an equitable charge over any other assets, and they will rank above any other borrower, including HMRC. So the bank get first shout at any security that's recovered. They don't have the cost of the capital to put in for it. And then to top it off, they charge a lot more for it. Because there are two charges with invoice finance. They charge you effectively an interest rate on the money you borrow, which is calculated daily. And they charge you a service fee, which is based on the amount of turnover you do. And that's usually expressed as a percentage of your turnover, normally with a minimum. So whereas you might have an overdraft facility of £100,000 with an interest rate of, say, 6 over base and a 1% renewal fee each year, where with invoice finance you might have an interest rate of 4 or 5 over base but a minimum service fee of £6,000 or £7,000 a year. That's why they love it. It costs them less, it's more secure, and they charge a lot more for it.
Okay, thank you very much. I think you briefly covered the next question. Simon asked, my bank has cut my overdraft limit even though I rarely use it.
Yeah, it's the same issue again, it's the capital. If you're not using your overdraft facility, the bank is going to look for any opportunity to reduce it down because they want to use the capital somewhere else where they are going to make money on it. The other alternative is they may charge you a non-utilisation fee. So let's just think about that for a second. The bank will charge you for not using your overdraft. So they'll charge you your 1% arrangement fee, and then they might charge you another 2% because you didn't use it. Yeah. But capital is a real cost for the banks. It's can't be avoided. They have to get the capital, and the shareholders expect a return on it. Well, most of the banks that are not owned by the government do anyway. There we go. Any more questions?
Okay, thank you very much, Ian, for hosting today's webinar. I'll be sending out a copy of the presentation and, as you saw, Ian's contact details out to you all very shortly. But before we close, just a quick reminder that excuse me, this webinar is part of our service to our Smart Room members. If you're not already a member or a BizSmart client or would like to access our archive of webinars, then please do visit our website biz-smart.co.uk and go to the Smart Room page. We hope you enjoy the rest of your day and that you can join us again very, very soon. Thank you for listening.